Welcome to Earnings Intelligence. Today, we're cracking open the books on Berkshire Hathaway's 2013 annual report. And to really get it, you got to picture the scene, right? The world economy is kind of getting back on its feet, and the stock market, well, it's in the middle of a massive bull run. Everyone's feeling optimistic, and for a company like Berkshire, that meant it was a time for some absolutely huge gains. And let's just get right to it. Here's the number that really tells the story of Berkshire's year: $34.2 billion. I mean, just let that sink in. That's how much Warren Buffett and his team grew the company's net worth in just 1 year. It's just a staggering result, no matter how you slice it. Okay, but here's where the story gets really interesting. Yeah, that huge gain is great, but Berkshire's book value only grew by 18.2%. Now, that sounds amazing on its own, right? But then you look at the S&P 500, which returned a mind-blowing 32.4% that same year. So here's the deal. In a super hot market, Berkshire actually fell behind. By a lot. But, and this is a huge but, just look at that long-term number. Since 1965, they've almost doubled the market's return, on average every single year. That's the real story. And you know what? This is classic Buffett. He didn't shy away from this underperformance. He tackled it head-on in the report. He wasn't making excuses or anything like that. No, he was basically laying out his core strategy, telling shareholders, hey, this is exactly what we expect to happen in strong markets. It really drives home that for him, it is all about the long game. All right, so here's our game plan for today. We're going to break this whole thing down. First, we'll hit the 2013 scorecard, get into the metrics that really matter. Then we'll decode their financial engine. After that, we're going elephant hunting to see what they bought. Then we'll analyze that famous Big Four portfolio, and we'll wrap it all up by pulling out the core Berkshire philosophy from everything that happened that year. So let's dive right into Section 1, the 2013 scorecard. We're going to go way beyond those headline numbers we just talked about. Look, if you want to understand Berkshire, you have to get this one concept: intrinsic value. Now, this isn't some number you're going to find on a balance sheet. Nope. This is Buffett's personal estimate of what a business is really worth. It's his guiding light, his North Star for pretty much every single decision. So you might be asking, if intrinsic value is the real goal, then why does he always talk about book value? Well, it's pretty simple, really. It's the closest thing we have that's publicly trackable. Buffett himself calls it a rough tracking indicator. It's not perfect, not by a long shot, but it's a decent enough yardstick to see how they're doing from 1 year to the next. Okay, time to pop the hood and see what's really going on inside this thing. Welcome to Section 2, Decoding the Financial Engine. This is where we get to see what truly makes the Berkshire machine tick. First up, let's talk net income. You've probably heard it called the bottom line. And really, that's exactly what it is. Think of it as what's left in the cash register after you've paid every single expense, every tax, every bill. It's really the purest way to see how profitable a company was over a certain period. And for Berkshire in 2013, their net income was almost $19.5 billion. You can think of this as the company's annual take-home pay. It's just a huge, huge number that really shows you how incredibly profitable that whole collection of businesses under the Berkshire umbrella actually is. All right, now let's get to the secret sauce, the special fuel that powers this entire machine. We're talking about insurance float. So what is it? It's all the cash that insurance customers pay up front in premiums. The magic is that Berkshire gets to hold on to that money and invest it for themselves, sometimes for decades, before they ever have to pay out any claims. And by the end of 2013, how much float did they have? $77 billion. Just wow. To put that into perspective, it's like having a massive interest-free loan from all your customers, a loan that you get to go out and invest for your own benefit. And what's even crazier is that for 11 years straight at this point, their insurance businesses were so well run that this loan actually paid them. It didn't cost them a dime. So what do you do with all that cash piling up? Well, if you're Warren Buffett, you go hunting for what he calls elephants. And that brings us to Section 3, hunting for elephants. Let's see how Berkshire put all that capital to work back in 2013. So 2013 was a big year for deals. 2 huge ones, in fact. First, you had NV Energy. That was a classic Berkshire playbook move. Their utility division just bought the whole company outright. Paid cash. Simple. But the Heinz deal, that was something totally different. Here, Berkshire teamed up with 3G Capital. They acted more like a bank, providing a ton of financing in return for some really nice high-yielding preferred stock and a big piece of the regular stock, too. Buffett himself even called it a partnership template for how they could do giant deals in the future. But, you know, it's not always about landing these massive elephants. Berkshire is constantly and I mean constantly, making what they call bolt-on acquisitions. Just think of it like this. They're smaller deals where their existing companies buy another business that fits right in. It's like adding a turbocharger or some high-performance part to an engine that's already incredibly powerful. And believe me, in 2013, these bolt-ons were a really big part of the story. We're talking 25 separate deals that added up to more than $3 billion. They're so important because they put billions of dollars to work, they make the core businesses stronger, and, this is key, they're all handled by the managers on the ground. That leaves Buffett and Munger free to do what they do best, keep searching for the next giant. All right, let's switch gears and talk about the stock market, specifically where Berkshire puts its money. This is Section 4, the Big Four portfolio, and it's all about a strategy of super concentrated conviction. So, you know how everyone talks about diversification? Well, you can kind of throw that idea out the window here. Back in 2013, Berkshire's stock portfolio was a masterclass in the exact opposite, concentration. Get this, just 4 companies, American Express, Coca-Cola, IBM, and Wells Fargo, made up way more than half of the portfolio's entire value. And these aren't just random picks, of course. These are what Buffett famously calls businesses with wide, durable moats. You know, you think of Coke's brand name, the Amex payment network, Wells Fargo's deep roots in banking, IBM's hold on big corporations. This is the definition of putting your biggest bets on the ideas you believe in the most. But here's what's really, really cool. It's how their ownership in all 4 of these companies went up. See, for Wells Fargo and IBM, they were actively out there buying more shares. But for Coca-Cola and American Express, their piece of the pie got bigger without them doing a single thing. Why? Because those companies were busy buying back their own stock. It's just this incredibly powerful, passive way to own more and more of a fantastic business. And don't let those small percentage changes fool you. The impact is absolutely massive. Buffett actually broke it down in the letter. For just these 4 companies, every tiny 0.1% increase in their ownership stake added about $50 million to Berkshire's slice of their yearly earnings. It just goes to show you the mind-boggling scale they're operating on. Okay, for our last section, let's zoom all the way out. This is Section 5, the Berkshire philosophy. What are the timeless lessons we can pull from this one specific year? You know, one of the biggest lessons you can take from any Berkshire report is humility. And 2013 was no different. Buffett comes right out and admits to making mistakes, to buying businesses that just turned out to be, well, duds. There's no sugarcoating it at all. He owns up to his errors, he notes that thankfully they were relatively small ones, and he's totally upfront that he's going to make more mistakes down the road. So if we boil it all down, what are the golden rules we can take away from 2013? Well, there are 3 big ones. First, always focus on per share value. Don't just get bigger to get bigger. Second, buy amazing businesses with the plan to hold them, well, pretty much forever. And third, be smart about using that incredible power of insurance float to fuel your investments. And that brings us to a final thought to leave you with. We've talked a lot about how obsessed Buffett is with the intrinsic value of a business. So why don't we take that idea and just zoom out a bit? What is the true underlying long-term value of the most important companies or assets in your life? And I'm not just talking about financial stuff. I mean your career, your relationships, everything.